In our view, I think interest rate environment is peaking. The probability of interest rate coming down end of this year or next year is definitely higher than the probability of interest rate going up. So I think we are in a pole position to continue our growth.
Welcome to the Financial Coconut Podcast. I'm your host, Reggie, aka your Chief Financial Coconut. And today we're on the Be Retired series in collaboration with SGX and REITs, right? And I have a great co-host with me, always with me on investment stuff. You want to introduce yourself for our audience that don't know you?
Well, if you haven't heard enough of PFC and you don't know me, I'm Anthony. I'm ad hoc, but now I have a more permanent role. Hopefully.
We're relaunching
we are relaunching a new investment series, not only focusing on stock like stock keycard, which we did previously, but also property, alternatives, crypto. So if there's anything you're interested in, if there are guests you think that are interesting to you and you would like us to speak to, please do reach out and let us know.
Very happy to be with Adrian. You want to introduce yourself?
Hey, morning guys. Morning. Thanks for inviting me to your program and the series as well. I'm Adrian Chui. I'm the CEO and Executive Director of ESR REIT. As you know, ESR REIT is actually a SGX-listed real estate investment trust. We focus ourselves on logistics as well as other industrial properties. Primarily is logistics properties. For our REIT, we are about 5.1 billion AUM, or assets under management, as people like to call it in short, AUM. Assets are actually focused in the countries of Singapore, Japan, and Australia. The intention is to provide stable distributions, and actually that is why our assets are all in very developed Asian countries.
The main thing to lay down is you guys had a merger not too long ago, right? Pretty much.
Oh yeah. We actually for the last 7 years we undergone 2 mergers and acquisitions. I think the first one was back in 2018, and then the last one was back in 2022, and to land out where we are today.
Yeah. What's the state of the merger so far? How has the synergy come along? What is happening on that front between ESR and LOGOS?
It has been successful. We've been integrated already. It's been like close to 2 years since we have done a merger. There isn't any fear about whether there's any integration problems or not, because we all operate in the same sector. It is not like a cross-sector kind where your hotels merge with an office. We're all in the same industrial sector, so everyone actually knows everyone. We know our processes or SOPs, as we say. Not much of a difference. It's been going pretty well, but obviously the challenges is the last 12 to 15 months is always our friends call inflation and high interest rate environment. But in fact, because we are a larger REIT, we are more able to withstand the high inflation and interest rate environment that's been hitting everyone across the board. I think if you talk to Kenny, I talked to him a few times, and he will tell you that inflation monster and that the high interest rate monster has really gobbled up, especially the smaller REITs, and make some of the REITs collapse. I think we didn't. In fact, we are in a very good position today. We have low leverage. We sold assets earlier before interest rate rises. We raised money very early before the REIT sector became the non-darling. And right now we're sitting on a good debt headroom that we can look for growing. In our view, I think interest rate environment is peaking. The probability of interest rate coming down end of this year or next year is definitely higher than the probability of interest rate going up. So I think we are in a pole position to continue our growth. Kenny has also asked me before, so what have you been doing in the last 12 months? If you're not looking at acquisitions, you're not looking at growth. As you know, we always do looking at growth, but because where the environment is, we sort of calibrate our growth expectations and our budget, and depending on the macro environment and the capital markets environment. So what we've been focusing the last 12 to 18 months is complete our asset enhancements, do it well, and that is why 2 of our 3 asset enhancements initiative, 21 Senoko Loop, 21B Senoko Loop, as well as 7002 Ang Mo Kio, which we started about 1.5 years ago, was obtained TOP in October last year and November last year, and starting to contribute income. At the same time, we focus our efforts to ensure that we have a proper sustainability plan.
Everybody has a
decarbonization roadmap,
plan.
It's right?
Yeah. Suddenly it's important.
It's
right?
almost going to be.
I think in the early days, people look at it as another listed requirement. I think as practitioners, we do see the impact of
Even at the
sustainability.
industrial REIT level.
Oh, of course. I mean,
Especially
real
at
estate
industrial
has
level,
always been
right?
banded out as one of the biggest carbon emitters
Fair.
for any sector. So I think we got to do our job. If everyone feels that it's just a check in the box, I think the world is going to be worse off. So I think we do our part. And that is why I think we have a proper sustainability program, strategy, decarbonisation roadmap, clear targets. And it's not just on the physical real estate. Then how do you link with your financing as well? So it become a new sort of ecosystem. And then we start to then look at ourselves and say, okay, if this is your sustainability plan, if this is your targets that you're going to meet, this is what the banks will finance you on. Then how does it affect your acquisitions target? I mean, you can't be having a sustainability plan and then you start to buy assets that is not sustainable or not green feature. If it's sole purpose, then you'll never be able to.
Or it adds too much to your cost, and then that versus your IRR. Right?
Exactly.
So.
Now, at the same time, we also had conversations with our so-called institutional investors. I think most people would share with you that the last 2 years, sustainability questions has come up to us, especially from institutional investors. They ask us for sustainability plans. What are your improvements? What are your targets? So we gave them a roadmap, we developed a roadmap, and then we now ask them the hard questions. All this needs money. So are you prepared to be sharing that, that cost and because it does affect returns.
Yeah.
So we had a good conversation. So the last 12 to 15 months is really getting all this important. You need to do asset enhancement. You still need to grow. You still need to make your properties relevant. We still need to rejuvenate our portfolio. I always tell people that industrial assets, whether logistics or high-specs building, the lifespan and useful life of an industrial building actually is shorter than your offices and compared on retail malls. Why? Because the wear and tear. We have logistics assets, the forklifts that they're driving around, the wear and tear as compared to, those swanky office that you see behind. We wear shoes, we wear heels. The most they need to change the carpet. But the wear and tear of industrial building, it's high. And on top of that, technology changes. The companies, the MNCs that becomes a tenant, they change their manufacturing process, they use better technology, and has impact on the building that actually we need to provide. They need more power, they need more fire safety, and then you add sustainability features. So that is why we always have to rejuvenate our portfolio, do asset enhancements more frequently because of the wear and tear as well as changes in technology. So that's what we're doing the last 12 to 15 months. At the same time, while we were able to focus on that too, because our leverage was low, we raised money early, we sold assets earlier, so that two monsters that Kenny always say, inflation as well as interest rate, the shadow wasn't too big on us. And that was we were focused on that.
But it does sound like industrial REIT is a very difficult business.
No, I don't think it's a difficult business. I don't think there is any easy business when you're in that. The most important part is whether are you able to stay relevant? Are your assets going to be dated? If they are dated, what are you going to do? Do you divest them? Or do you redevelop them? Do you do asset enhancements? And a lot, it depends on that, Yeah, people like to say, hey, Adrian, you're just a landlord. Your job is to every day sit down there. Your best job, just collect rental. Yeah, I wish so. But I think no business are difficult. I mean, you speak to my peers who manages hotels and offices, they will tell you they have their own challenges. Yeah. We do have as well. But we try to evolve with the business. That's the most important thing. Making sure that we manage our assets well. Assets stay relevant. And as long as your assets are stay relevant, you will have the tenants that will ensure that your buildings continue to be income producing.
I think that's great. A lot of follow-up questions I want to ask from that.
Yes.
But maybe just we drill down into the sustainability part
yes.
first, right? So in terms of, you mentioned the target, you mentioned the roadmap, you mentioned the cost. Can you be a bit more specific about that? Are you really looking at being net zero by, let's say, 2035, 2050? What sort of costs and capex are you expecting to be needed to drive towards that?
I think we have our targets put out. We try to first focus on making sure water and utilities. We have started our journey and proper plan only this year. So there's targets that set for us in terms of water usage, electricity usage, solar panels and recycling bins, as well as working with processes with tenant. So at the same time, we also need to adhere to some of the reporting, data management system, collection of data. People like to say, oh, I have a net zero target by this and all. But actually, sometimes the most difficult part is to collect the data. How do you verify the data? So we have to change and look at some of the leases that we sign, because data collection is the hardest. You can have net zero, but if you don't have the data and you don't know whether are you going to the net zero.
You can't self-declare, right? Net
Exactly.
zero.
You can't, you have to validate,
Yes.
You can't self-declare. Like people like to say, own self check own self, right? You can't do that, right? Okay.
Yeah, you
Shots
can't.
fired.
Yeah. So you have to do it. So we have to talk to the tenants and tell the tenants, we are embarking on this. It's also good for you. And then some of the things that the leases as well. So the leases, then when we renew leases or we sign on new tenants, we'll put in this requirement that we have. At the same time, we're also moving towards green leases, have certain targets and all. So I think in terms of returns, I don't think right now you will see that there are certain returns, but you don't see as if it's like 20-30%. I think the key is people should not, when you look at sustainability as well right now, is return should not be the first criteria. I think the first criteria people look at it is, are you doing the right thing? And is it sustainable in the long run, that your business and the way you conduct your business, the way that you offer your products, is it something that has longevity and continue to go through? If the buildings requires green features and carbon emission taxes are coming, if you don't do that, it actually becomes a cost itself. So I think both the longevity of the business and how you conduct it, can you continue to survive in this, as well as financial returns should come hand in hand and not one way or the other. So there should be, I think in my view, there should be certain acceptance of business owners as well as investors that this is something that we should look at.
I want to ask a little bit about that, the investor side of things, right? So, all these capex going in, trying to stay relevant, greening the whole place. It's a story. We all get it, right? But how is it affecting your kind of rental reversions? Right? Are we seeing like rent moving up as a result of this, or is this just like capex that have to go in just for the sake of, because legislation had moved down this past year to stay relevant?
Right now, no. Right now, I think at the end of the day, it's still the owners are still looking at P&L. Put it this way, I have building A and building B next to each other. Building A has all the green mark gold. The other one is technically not yet. You don't get the rental difference. And at the same time, for capital values, when you do valuation, it's not inside there. Yeah, but for us, we still have to do it because we probably know that eventually they have to take that into considerations. Okay. And there are also certain attractive features of certain multi-tenant, multi-MNCs who actually have some of the criteria when it comes to that as well. Things are evolving, but as you say, whether is that today there's a differential between the two, I'm not seeing, at least for my portfolio. I can't speak for
fair.
other landlords.
We just need to understand your portfolio.
Yes.
Yeah. Okay.
Yeah. So I mean, it sounded from the very beginning like this is a tough spot to be in, right? Because people require that of you. You can't pass that cost down. But I think maybe it's a bit of skating to where the puck is, where you are thinking, well, for now, that's the case, yes. But long term, for the business to survive, it's coming. Carbon taxes are coming. It's going to add to my cost in the end, and maybe the cost of doing capex now would be lower than an annual carbon tax.
Yes,
right. So there's a value judgment there, business judgment there. So
but is there some sort of modeling that you do within your team to kind of evaluate this?
Not really.
Okay.
I mean, we're not that sophisticated to try to go there. As I said, we are still at early stages. The key is to make sure that you get the lower hanging fruits first.
Fair.
And to make sure that you deliver your targets first. Because at the end of the day, you can promise the whole world, but you should deliver what you have put out as a target, which you have put out. And then it becomes more believable.
About sustainability, that maybe at the end of the day, it's not only passing that cost down to your end customers, right? It's also about whether your banks can give you a cheaper loan, and if a sustainability linked loan, as you said, whether you can get better tenants, which maybe you want to offer slightly higher rates or have a bit more stability, or you worry less about their credit. So there's a bit of, it doesn't necessarily reflect directly in the financials, but there might be a bit of ancillary benefits to actually trying to be more sustainable.
Yes, that one I do agree with you at this point in time.
But do institutions are there like green capital institutions that are looking to invest because you meet a certain
there are.
DBS and OCBC love it.
No, I'm not talking about loans. I'm talking about like Insti Capital buying
There are.
the units.
I wouldn't
right?
say that
They price it higher as a result of it.
No, I don't think there's a price higher, but I think there are more pools of money.
Okay.
On that, a wider pool of money.
So there's a wider unit holder pool.
Exactly.
Okay. But they're not exactly pricing that into how they.
Not that I see at the moment.
Okay, fair. So hopefully they will lah. Right?
That's what we want to do.
That's your mandate, right? You say you want to do that, then you should price us higher.
More flows means higher price, right?
Yeah, exactly.
Okay, great. So and then there's a big part in your business which is asset enhancement, right? It's always there. Always there.
Yes.
Forever there's a narrative.
Yes.
Asset enhancement.
Yes.
Right. So help us understand, asset enhancement within your portfolio. How does it look like? How do you think about this thing? And that whole jazz.
It all comes back to making sure that your asset stays relevant, as I mentioned earlier. To make sure that asset becomes relevant, it's not dated. You look at where the demand of the market is, who are the end users, what are the requirements going to that. So asset enhancement is always part of our DNA and part of the strategy that you do. I mean, a lot of people says that asset enhancements, and when we look at asset enhancements, we need to have returns. And you ask yourself, if you spend $50 million doing asset enhancement, adding a new floor, adding a new wing, how much can you rent it out for? Can you not only enhance the rental of the new space, but what about the existing space? Does it create a community? Does it create a better cross-selling between that, provide the flexibility from the tenants from the old building to expand into the new building, and then and amalgamate the floor area together. So we look at that. So generally we do have internal rate of returns when we want to spend money. Certain return requirements, obviously, definitely must have a certain margin above our cost of funding. That's the first criteria. And then the second one is obviously to see whether overall qualitative perspective, does it make this building a bit more relevant as a whole? How does it impact the rentals of the existing tenants that are there? Because when you go to new wing, everybody wants to go to the new wing, right? Yeah, but what about the existing guys, right? So you sometimes do asset enhancement. You don't really try to just plug the new wing. You also do the new wing. Then after that, you try to enhance also the existing. Maybe I wouldn't say cosmetic, but also you upgrade the capex at the common areas, the toilets, the lobbies, so that you don't look like a salt hum, right?
So that both things look about the same. Right?
Yeah, but you obviously focus on the first part.
Yeah.
You focus on the first part first because that's the one that you create a new GFA. But as part of the process, when you are doing the asset enhancement, you should look at the thing as a whole. Asset enhancements can be various forms, like what we do in 7002 Ang Mo Kio. It was a car park that is open air. Nowadays, there's not many car parks that are open air. So we had unutilized plot ratio.
Open air car park feels like a low-hanging fruit, right?
Yeah,
it's like
easier. It's easier.
Yeah.
I would say that it's easier. But it's also because there's unutilized plot ratio. So we built a new block of 250,000 square feet. We call it 7002 Ang Mo Kio. The existing building was called 7,000 Ang Mo Kio. So the naming is not very creative, but but it works, right?
Is it industrial REIT? Don't need to have very creative.
No,
it's very practical. Right? I just need to use this.
This is the
right?
practical.
Clear is important.
Exactly, clarity, simple, boring. That's important.
Yeah.
So we had that. We also had another asset enhancements. You can call it asset enhancement. You can call it redevelopment. That's called 21B Senoko Loop.
What's the difference? Redevelopment, asset enhancement.
I think the difference is probably the amount of capex and the amount of work that you do. Asset enhancements tend to be it's just there. You just build up. All right. That means the superstructure is already there. Redevelopment is you to take down and then build up again.
Okay.
So I think I would say 21B Senoko Loop is probably more like a redevelopment than a major asset enhancement. That one was an old industrial building, the flatted factory kinds that you say that in the 90s and the early 2000s. That one previously, it was a manufacturing building with a dormitory. I mean, in the early 1990s and 2000s, the process was that it's good to have a dormitory where your workers can stay, and then you just go down, do a manufacturing, and then you go up, and everybody can keep that together. But I think after COVID changed because of the dormitories.
Yeah.
So and we can't just rent out dormitories because it's not allowed, because you only can rent the dormitories to the company that is actually doing renting the production space. So we thought, and then we have a tenant called NTS who came to us and said, they're looking to consolidate the space. They want a new building, and that's why we do a build to suit for them into the high specs building, and they are the only tenant that's there. So they are expanding in Singapore. They consolidate we understand they consolidate some of their activities in the region also into this space, which basically gives a confidence boost to the Singapore brand. And once you have more economic activities here, it just benefits landlords like us. So we undertook the asset enhancement, redevelopment for them. And so it's already achieved TOP and it's income productive.
That's very interesting, because every time I think of industrial and light industry in Singapore, I always think of it as something that's retreating and not something that's actually
No, I don't think so. I think just like us, the country is always evolving. New industry, yes, there will be industries who will exit. But there are industries new industries that come in here. Our job is to make sure that we know which are the industries that's going to be sunset, which are the industries that are coming in, that is going to come in, and then making sure that our properties today are relevant to the people who are here already, are already coming in, and then plan ourselves for the people, to the industry that we are going to come in. So I think the country, the economic fabric has changed a lot. Manufacturing sector overall, and that's why for us, because 75% of our assets are in Singapore, we are also in a way link, I wouldn't say a proxy, but a link to the economic activities of Singapore.
Fair. Actually, tell me a little bit more about this build to suit, right? I mean, you're essentially front loading the capital.
Yes.
Right? And then you build it specific for this one tenant.
Correct.
Right? For maybe 15, 20 years,
yes.
they sign a long lease.
Yes.
Right? So what is that thought process when you look at it from a financial standpoint? And are you going to get, rental reversions over this cost? How do you structure this for
So
them?
we look at first the asset. Right? There must be an asset standalone. You must have a look at the internal rate of return. Can you get a return from this asset? The answer is yes, it meets our return threshold as a standalone. Then we say, okay, go. But there's always the pros and the cons. The pros is that long-term lease gives you stable as a standalone. You don't have to worry. This guy will be for the next 15 to 20 years. And generally for long leases, you have either fixed rental escalations, or sometimes you have fixed rental escalation for a few years. You have a market review, and then you continue with the rental. But you need to balance it out, right? If you want a fixed rental escalation, argument say 2% per annum for the next 15 years. If inflation goes 5% every year, then you're out of money. But if you think that, that I want to put in some market reviews in between the 15 to 20 years, then you also taking the risk that when the market review, the time come property supply is a lot, then you also have a risk. So then how do we look at that risk? That risk is looking at the whole portfolio, right? So you first look at the returns. Does it meet your return requirements? Does it give you a margin, fair value of margin over the funding costs, that essentially the returns actually commensurate the risk that you're taking? Because as a build to suit, the tenant is there already. Before you do the first piling, the tenant is there. So you don't have leasing risk. That's a good part. So you look at the asset first. After you look at the asset, then you ask yourself, now I put this asset now in my whole portfolio. What benefits does it come? Now, if my portfolio has a lot of already multi-tenanted, that's on 2 years, 3 years, that you always have that rental reversions. If in an up cycle, right, it's good because it means that positive. But if you're going to see that, supply is coming out the next 3 years, it means your rental reversions is likely to go down. This asset that's added to it actually is good because it gives you the stable distribution. So we tend to see build to suit as how does it enhance the overall portfolio. Once your standalone is there, it's good to go, you go. And then the extras will be what does it impact on your whole portfolio in terms of, does it give more stability, more stable long-term growth? For us, if you look at it, we bulk out of Singapore. As you are aware, Singapore general leases are about 3 years. We have 75% of assets in Singapore. So generally, you say the majority of the Singapore leases are actually on a rolling 3-year basis. So adding that to the portfolio actually enhance the stability. Right now, our portfolio, most of the long-term leases comes from overseas. Because in my country of Australia and Japan, they tend to sign longer leases. So in Singapore, you generally don't find many industrial tenants signing that long unless it's a build to suit. So we see that as an extension of diversification and stability, providing stability of income stream.
It's a engineering strategy on your end, essentially.
It's a balance. It's a balance.
Yeah.
Diversifying risk. Diversifying risk can also cut both ways. If you diversify too much, then there's no growth.
Yeah,
I mean, it's always risk return, right?
Exactly. Fair.
Yes.
So actually, I want to dig deeper on what you were saying just now about supply, right?
Yes.
So, from your professional standpoint, being in this space, are you seeing supply coming in terms of space, like industry?
Not really. I think if you look at logistics space, it's still.
So no one is putting money to build.
No, I don't think no one is putting money to build. But Singapore by itself, there's so much land, right? And the supply that is coming up I think it's quite balanced. I think 2021, I would say there was real short supply. Even 2022, I must say there's real short supply. We just came out of COVID. So there are a lot of backlogs all the rules then, right? Only 50% of people can work. How do you construct a warehouse with 50%? Do you get the aircon? You do get the aircon guy to go in first, or So I think there was a great backlog of supply, and it was started to clear the real. That's why you see rental reversions, logistic rental reversions shooting very high, because there's just no supply. And then you add with supply chain disruptions, and that fuel the demand as well. But I think the last 2023, it has eased off. Is there a huge some people say, 2023, 2024, huge supply of logistics was coming up, but those were the backlogs ones that is trying to fill up that demand that was there. Or else you were going to see logistics rentals going like every year 15-20%.
So maybe just to leech onto that, right? Like there's moderating supply that's balancing out the COVID effect. I think that's fine. A part of the theme for a bit of logistics REITs as well, there's the growth of e-commerce, right? There's the growth of the need for more logistics properties, because logistics as an industry is becoming more important.
Yes.
Are you seeing post-COVID a different trend in demand?
Okay, I would say, broadly speaking, before COVID, people see logistics as a supporting industry. Immediately after COVID, everybody got to stay at home. So e-commerce became the big thing. So there was a little bit of that short-term impact. But that short-term impact, not short-term, 3-4 years of after COVID and aftermath of COVID actually changed the way people think about how we produce our goods, how we deliver our goods, and how we consume our goods. So, and with the advancement in technology of all these apps and all this stuff, it became easier. You don't really need to go to the supermarket to buy your washing powders. Sometimes even fresh produce, you could get it from the web. So e-commerce boomed during that partly because of the pandemic, and people got used to it, and people said, hey, actually, it's not a bad thing to work from home, right? So e-commerce side, 2-3 years after COVID, or even now, not now, 2-3 years, it was the same as data centers, because everybody work from home. You just have to, just have to have some bandwidth and all. So that, and then coupled by all the ports closing down, supply chain disruptions, it just basically found that, people say, hey, actually logistics is that it's important. Now, we've come out of 4 years since COVID. I think really the demographics of how we produce goods, consume goods, and deliver goods have changed. Now we are seeing, obviously, the boom of people going back to work. So it means your e-commerce does not technically...
Got tarik a bit lah.
Tarik a little bit down. But it has not gone away. Okay, it has not gone away. If e-commerce was here before COVID, and COVID was here, today I think we are here. But if you compare, we are still there, because lifestyle has changed. The things that we do have actually changed. But what we are seeing as well is that businesses has also started to look, businesses, manufacturer end users, has started to take logistics seriously because of supply chain disruptions. And the supply chain disruptions is also exacerbated by geopolitical risk. US-China trade tensions, the Ukraine-Russian war, but the Middle East situation that's going there has muddled up all the supply chain.
And that's going to be the follow-on question, right? Like with geopolitics, there's a duplication of supply chains. People try to be safer. It's no longer just in time manufacturing.
Yes.
Has that impacted Singapore? Right? Because your
it has become better for us. So just in time, as you said, I think it was coined by the Japanese. Right?
That was
Toyota.
They came out of it.
But just in time works only if supply chain works, because you need to know. It's very easy to monitor when your inventory goes down. It's a supplying side. You need to know the freight schedules, the port schedules, to get it there. So GIT really depends on our supply chain, but that with all the geopolitical everything sort of muddled up everything. So now it has no more become GIT, it has become GIC, just in case. So manufacturers decide to hold back, store raw materials, because if one component is not there, you can't start the production. And also they also store finished products, right? Because they run Singapore manufacturing and all this stuff is not produced for the Singapore market. It's produced for various different markets. So they are starting to control that. So we're starting to see MNCs having their own logistics arms. Prior to COVID, most of our tenants, logistics tenants, are the 3PLs, your FedEx,
DHL,
your DHL.
yeah.
Today we still have them, but we also have MNC's own logistics arm. So it has changed. So that is why I said COVID, and the aftermath of COVID now, has made circular trends change. It comes back to the three words: the way we produce goods, the way we deliver goods, and the way we consume goods have changed. And at the end of the day, what is behind all these 3 points? Logistics / supply chain. So I start to tell people that in my view, logistics and maybe data centers are the backbone of the economy right now. Because if you want to buy something, you want to get your raw material supply in, you need the supply chain.
Yeah.
And you want to have the supply chain, you need the app to...
Yeah. I get it. Yeah. So I get it, right? But that's the mother trend, right? That's a big trend.
Yes.
How are you capturing that trend, right? Like, are you gonna do more build to suit? Are you gonna be acquiring, since your gearing is quite low, or are you seeing more demand, so you're engineering a higher rental, all that? So how are you capturing
it is
that?
a balancing of three balls.
Yeah.
I mean, existing properties, you make sure that you lease up to the best tenants. At the same time, when you redevelop, you try to redevelop to certain asset classes that are more in demand. I give you an example. Probably I use COVID as a milestone point. Prior to COVID, most of our warehouses that we have are ambient. That means no aircon, nothing, all this. Today, we actually have aircon warehouses. Not all, but can be like an ambient warehouse that's 5-story, first 2-story or first 3 stories, we put aircon, and the top 2 no. Why? Because some tenants that we have, they have high value goods, optical instruments that need climate control, temperature as well as humidity, require climate control. You have pharmaceutical drugs, you need to have climate control. So because of that, that's where we make ourselves, change your product to be more relevant to all this store the demand. We also have cold stores, cold stores facilities, because food security has become important. There's shortage of cold stores facilities. So now our logistics assets also offer cold stores. So to answer your point, that's exactly what I'm saying. I mean, that's what we are doing as an enhancement part. Now, at the same time, as part of because we believe that the circular trend is there, how do you capture that circular trend? Part of the plan is also then it becomes acquisitions. Now, you're right, our leverage is low. And one of the fourth point is, then what about those assets that you cannot asset enhance, you cannot redevelop? What do? You sell.
You divest and recycle capital.
Exactly. So that's what we've been doing. So I always tell people that, in end of 2022, we told the market that we're embarking on what we call a 4R strategy. I've been communicating to the market that the phase 1 of ELOG was always getting size. People start to focus, where is economies of scale? It's not economies of scale. It's not immediate, but the size is important, because when you have the size, you have the cloud. Banks start to talk to you. Tenants want to talk to you because you have more options for them, right? You are able to be more of I wouldn't say a price maker, but you can punch above your weight when you talk to the service providers. So the first 5-6 years is really good M&A, to mergers and acquisitions, get ourselves to where we are. Now we're down into phase 2. The phase 2 is now to make sure that your assets are staying relevant, capturing the so-called your mother trend that you're talking about. And that is where, and if you're too small, you can't capture that. You need the bigger ship to ride the big waves. So that's what we are doing. At the end of 2022, that's what we did. We embarked on a 4R strategy, which essentially, what does it mean? First, you have to reinforce reinforce your balance sheet. You have to rejuvenate your portfolio. You have to recycle your capital. And then you must have your sponsors who have good assets to reinforce the support for you, because there's always pipeline of assets that we have. So we rebalance our balance sheet at the start of the year in 2023 with a fundraising. We make sure, and that was at the also right time where interest rate environment was starting to go up. Inflation was sticky. Inflation impacting interest rate goes up. And we were of the view during then, early 2023, that if interest rate continues to be very sticky and very high, it would definitely affect discount rates as well as cap rates, which impacts valuation. So when discount rate goes up, discounted cash flow tell you valuation comes down. If valuation comes down, it means that your gearing will go up.
Yes.
Right? So where everybody was focusing on, if interest rate doubles, DPU will drop. That's a foregone conclusion.
Yes.
But what do you think beyond that? So we thought that we need to rebalance our balance sheet. At the same time, to ride that wave, that big market trend that you are referring to, we think that we have to sell some of the assets that we can't do anything to it, whether asset enhance or redevelop. So that's where we start to sell assets, and we sold them pretty early because we are afraid that if you just hang on there for the extra $1, if interest rate shoots up, the cost of funding is more expensive for the buyer. What do you think he'll come back to you? He'll tell you to come back and drop price. So we settled it, we sold it, and by the first half of 2023, we've already rebalanced our balance sheet. We have half recycled, okay? But we continue to rejuvenate. And as I said, because after the shadow of the inflation monster was behind us, after we have rebalanced our balance sheet, we were able to focus on AEIs and redevelopments, which I just mentioned to 7,002 Ang Mo Kio and 21B Senoko Loop. And that's where we start to rejuvenate our portfolio. Rejuvenation of portfolio comes from asset enhancements, redevelopments. It comes from selling the older assets, the dated assets, and it comes from acquiring. So 2 of the R's we have done in 2023 in a way. So this year is really more the other 2 R's, which is recycling those money as well as getting our sponsors' support, especially from the asset pipelines that they have, to actually put back. I've sold a couple of assets. I need to put back.
Yeah.
Because
exactly.
if not, there's no income.
Yeah, exactly.
Yeah. So that is
you
what
can't
we're
just
doing.
put in the bank and 3% a year.
I hope it's 3%, but we're not getting 3%. So we explain this concept to our institution. The institution investors, which has a longer time frame, and they see the asset pipeline that my sponsor have very good quality, freehold as well as longer land lease assets. They understand where we're coming from. That's why when we did the placement in early 2023, $150 million, it was institutional guys. And during then, I didn't even tell them what I'm going to use the money for, but they know what I'm trying to do. And they know what they sponsor. So the institutional guys are more, I would say, have a longer view and looking at not just the immediate DPU. They're looking at, I also look at NAV. Because, Singapore industrial assets, the land leases are very short, 30 years or even less. Which means that if you do by simple mathematics, 1 divided by 30, you don't do anything. Every year, your land value, your property value drops by 3%. So you have to sell some of these lower ones and buy them into longer freehold assets, longer land lease, so that at least if you don't do anything, your asset value do not drop. So that's what we have been doing. I know a lot of people are asking me, so Adrian, are you going to redeploy?
Do the next thing, yeah.
Yeah, I think that's probably your next question.
Exactly. No, because you are in quite a unique situation, right? Relative to many other REITs, you have, maybe it's your understanding of the market, your wisdom, or also some element of luck, right? You drop a lot of those things, and then you grew, right? So
good timing.
So you timed it well, in some ways, yes. Right? Like you even have excess capital to buy funds, right?
Yes. And we do even do some share buyback.
Yeah,
as well,
exactly. So I want to understand, like you have excess capital sitting around. How are you going to deploy? When are you going to deploy it? Right? Like
that's the perennial question. Everybody asks me, are you going to deploy? My answer to you is yes. Yeah. Okay. When? This is where I think
when you find something that hits the correct IRR.
No, not really. I think it's probably time for us to deploy it as well. I mean, I could have as you said, my gearing was 35% even in August last year. But during that, our view is I don't think it's the right time yet because cost is still high. I think inflation, interest rate was still really going up, and we think that if we wait a bit longer, and if we are right, that discount rate starts to go up, valuations have to come down, you can wait. When we are not lowly geared, that's a worry for us. But when we are lowly geared, I'm on the other side.
I know.
I think right now where interest rate is a bit more peaking, and if you look at economic data where inflation is more or less there, at least it's still not climbing up. I think it's probably time for us to look at it. I think there has also been in the last 12 months also what we call cap rate expansion has come in a little bit. And then also think that the market has also changed in the sense that investors also look at managers or whether it's private equity managers or listed REIT managers to always look at recycling. I mean, you buy something, you must be able to sell, right? Then you know that the value is true, right? So,
it's not just on the books.
It's not like a valuation report. It's anyhow put a number out there, right?
So I think it's time for us, and we have been negotiating with, looking at a few opportunities from our sponsors, especially from our sponsors support, because our sponsors' assets are good, they're high quality, they're newly built, and that they are longer land lease freehold. And our focus, I know your next question will be, so where? Yeah, I always anticipate all these questions that will come.
As you should lah.
But it's fair, right? It is fair.
Yeah.
I mean, the question is, are you going to buy? When are you going to buy? And where
are you going to buy?
Right?
Yes.
And then then the fourth question is how much, right? Yeah, that's a standard question. I mean, we buy houses as well, right? So we all ask the same thing. So where? The question is where? The where part is actually, in my view, we're very focused on that. We are, as I said at the start of the session with you, we are focusing on developed countries. So Singapore, Japan, and Australia are the 3 countries that we will look at. And this will focus on this because that's our domain knowledge. The ESR groups has strong presence in all these 3 countries. You got to go back to your domain. And that is why in my portfolio, you will see that this new economy assets, especially logistics, and we're talking a whole talk about logistics. Why I keep talking about logistics is because that's our domain knowledge, the group's domain knowledge. What I say domain knowledge encompasses the whole real estate value chain, from developing, managing it, leasing it, marketing the space, the designing it. We know because the group has relationships and knowledge with all the different 3PLs and as well the manufacturing company, logistics guys. So we know who is shifting out of where, especially now with geopolitical risks, with people like to call the China Plus strategy, where they do their supply chain, right? Yeah. So you need to know where your customer is going. Is a customer from China going to Vietnam, or China is going to come to Singapore, and what are going where? So because we always have that relationship that's built over the years, because we have that domain knowledge. And then the guys knows what to build. Logistics company A, the requirement may be different from logistics company B. The turning radius of logistics company A requirement is different from B. Why? Because logistics company A, they have mostly 40-footer truck. Logistics company B is 20-footer truck. So you don't build.
Fair. Actually, since you brought it up, right, I understand that the parent company has advantages in the terrains that you're talking about.
Yes.
But from the DHR report, right, actually a lot of Chinese companies are moving into Vietnam,
Oh, yeah.
So I mean, I read their not specifically for this interview.
Yes,
but somehow I read it. It's like, oh, that's interesting. So the supply chain is changing, and Vietnam is quite an interesting place. But because you're
but
not...
it depends on what industry that's going.
Okay.
Right?
Okay.
I mean, higher valued one where rule of law, intellectual property rights are important, like drugs, pharmaceutical. I think you want to do it here. If you have a manufacturing facility that you need stable power because you're doing 24/7, like for example, semiconductors. When you're producing the process, the power cut off for 2 seconds, the whole batch is gone. Or no, those manufacturing that needs batches production. You don't want to go into a country where the grid is not stable, produce halfway blackout. Singapore has always been, the infrastructure here is very good. So that is the reason why I think it depends on, as I said, you need to have the domain knowledge to know who's going where and who's coming where. And then you try to capture that. And that's why I guess we have the ESR group, including ourselves, has that domain knowledge. And that helps us a lot. So when we do a when we do a redevelopment of multi-tenanted, I can tap onto my colleagues. They may tell you, hey, actually, I have a Korean logistics operator who's looking to come to Singapore. Some cold store operator from Korea or from Japan is trying to expand to this part of the world because their customers are coming here. Do you have something? Okay, yeah, come, let's talk. Same thing. Some of my tenants may have moved out. And then they try to locate to Korea. So, hey guys, I think this guy is... So I guess this is where that domain knowledge actually comes in. And it helps us a lot when we do our 4R strategy, especially when it comes to recycling part. So this year, We're focusing a lot on the recycling part. Everybody has been asking me. So I answer your fourth question, which is what's the price? I would say that it means our hurdle rate, our return requirements.
Then maybe just to a last question on this part, right? So two last questions. I think one is we've alluded a bit to the strength of the sponsor group and the pipeline that's coming up. Are you wedded to that pipeline, or and how do you view the strength of the sponsor being helpful or unhelpful to you?
Oh yeah.
What do we
so
do
the first part
first?
first. Am I wedded? No, I'm not wedded to have to buy from their assets. And at the same time, because I'm not wedded to them, they're not wedded to me. They don't have to sell to me.
So you don't have
first
like,
right
first
refusal.
refusal.
No, we don't have.
Okay.
Right? And also because the sponsor is also a listed company, they do have their own shareholders to answer to. So what do I do? Then somebody say, Adrian, then you're no different from the guy on the street because your sponsor will always go to the highest price. So I don't think so. That's necessarily the case. From the sponsor's perspective, if they've developed an asset that is great, that is good, you usually want to keep your family heirloom within your family. I can only put it in a very simple way. Unless the price difference is so big, I think it's better to do it. Now that's one. But you cannot always depend on your benevolence of the parents to pass the heirloom down to you. Because I am one of the many funds and groups within. So basically, I'm one of many kids. All right?
Fair. I get you.
So if my sponsor wants to pass me a GCB, I'm happy. But everyone will want to go for the GCB as well. So then what do we do? Right?
How do you convince your father?
So convincing is one thing. Second thing is when my parents group, that's why we invest in the income funds that is set up by our sponsor group. Why? Because if we invest in those funds, right? People say, isn't there a conflict? Then a conflict, like the Japan income fund we announced at the start of the year. We are going to Japan. Income fund is going to Japan. But why does people need to see that asset can only be owned by one person? Why can't it go on by, if there's an asset that is suitable for both of us, why can't we joint venture and buy it? Come back to layman's method analogy. Brothers and sisters share and buy a residential property as well. So why can't we do that? And at the same time, investing in the income fund also allows me, and it's a property cycle. There are times whereby the equity market is closed like now, or the cost of the REITs are so high, the cost of funding is high that you cannot buy the asset. So why let the asset goes to waste? So if it goes in the income fund and I invest in the income fund, I see an exposure in asset. The underlying point is that asset worth buying? Yeah. If that asset is worth buying, and you can afford it, by all means, go.
So it's just another way of getting exposure to different assets that you don't necessarily need to operate and rejuvenate.
Correct.
Because that also takes up your bandwidth and you still get a bit of economic exposure to
and most importantly, it becomes a pipeline for me. Because that income fund one day may have to sell, may have to do it.
You couple the whole fund, that is yours.
No, it's not.
It's not. I will acquire the asset from the fund.
Yes, and that's something that's important because I'm in an income fund. I actually have the performance every month.
You know the asset, right? So you de-risk you when you buy. It's not like something that you diligence third party when you buy. You know the asset.
I know how it has performed. So now past performance may not necessarily be reflective of future performance, but if this asset is put up for sale, if they want to let me buy, I can trigger it. If I think that this is good enough, it's useful for me, I can ask, can we buy from the fund? Yes, it's related party, so be it. There's so much clear rules with the party, you can go ahead with that. And if they still want to put up for sale, I actually have knowledge of the asset's performance and I can price it correctly for my REIT. So if I think that based on historical performance and I do my own functions, I do my own forecast, I think it will be this and I think it's worth $100 million. If it puts outside and I get a price of 120, somebody puts 120, I say sell it to them. And I still benefit from that 20 because I have a stake in that fund. So I still done my unit holders.
Fair. I hear you. I
so that is a strategy part.
Yeah.
In by why we take income fund. That's why we don't really take a lot of funds. Now, if you look at it, our whole portfolio. I mean, there are two other funds called Oxford Fund as well as LAFAS. Actually, that one is not really a fund. If you look at it, Oxford Fund is one asset. It's actually a tax structuring. But it's just called a fund. Okay. The real actual fund per se is actually the Australia EALP, we call it, ESR Australia Logistics Fund. as well as the Japan Income Fund. These are the two, and they're very small. So I think that's where we see ourselves, and that is getting access to the sponsors' quality assets. We are not wedded, but doesn't matter yet. But we create that linkage for us so that we still bear the surname.
Yeah. Fair. I
Then-
understand.
Yeah, but I think I have a bit. There's a bit of a cynical view out there,
Yes.
right? Like you have a sponsor, parent company, big one. There's the REIT, big but a bit smaller, parent-child relationship. Then is there, and of course there are related party transaction rules, but how does that lead to the dynamics of buying assets from your parents, right? Do you have to take, like your parent want to give you a plot of land that is in Malaysia that is not developed? Can you say no? You know,
Yes,
like the cynical view is that
yes.
the sponsor will always, take their chunk of money,
Yes.
and then I don't really need this asset anymore. They want to recycle their capital, right? So they sell it
Yes,
to the REIT.
it's correct.
Yeah.
Not necessarily. They as this, I can't speak for my sponsor, but the answer is that sponsor has to get the best price for their piece of land. That's the answer.
Okay.
And if it's a related party transaction, they can't vote. It's then my onus, in my view, first to convince my board that this is accretive and this is beneficial to the unit holders. Then the board says okay, and the IFA says okay before I put out the circular. So actually, you ask my frank opinion, buying sponsors' assets is actually harder. You have to be whiter than white. Whereas you buy a third party, the cynical view is always is. So actually from a REIT management, it's always, if I want to be lazy about it, it's actually better to buy from third party. Because to buy from a sponsor or sponsor-related entity, you got to jump through a lot of hoops. But that's not the point. Shareholders pay us a fee to make sure that we get the best assets, in our view, that commensurate the risk.
Okay.
So if and I think investors are today sophisticated. I mean, you must remember the Singapore REIT market. I hear this thing in 2022 when I was part of the early REITs in the Sanders REIT about this. 24 years later, I'm still hearing the same thing. But the last 24 years, we have more sophisticated REIT investors and stakeholders like yourself. But it has evolved around, and because of that, the related party rules has also changed. And we have seen over the last 20 odd years that actually shareholders reject IPT transactions as well. I think today's investors are more sophisticated, even the retail investors. Some of the questions at our AGMs that my retail shareholders ask are very relevant. And when we have sessions with them, we don't, from us at ESR-LOGOS REIT, we don't just meet retail shareholders once a year at AGM. We also have half-yearly so-called briefing where we work together with CS because they have more access to these people. So we have a session of 50 people. We just have a lunchtime, just come in, give them a bit of update. Some of the feedback that they give us are really good. I used to share with you, if you go back to many years ago, when you do placements, a lot of fund managers REIT managers want to do a placement overnight because it's very fast, 200, 300. Whereas if you do a Rex issue or a Pro Rex issue, it takes long. You can write circular, you can write this and why, right?
More cost also, right?
Yeah, more cost, more efforts. For the same $200 million, one is overnight, another take 2-3 weeks, write circular. The best is to put. But we have feedback from shareholders, tell us, hey, you put all this placement out, you buy accretive assets, you pass it to the fund manager, what about us? So we change. When we do fundraising, we do placement plus pref. And then when the preferential offer or rights issue or preferential offer, we ask our sponsor or some large shareholders who are behind to backstop it. Because we don't know whether the man on the street, the retail investor will take up your pro rata share, right? Yeah. But we need financial certainty. So that's where the sponsor came in. The sponsor said, guys, I've seen this asset. I'm a board member. I think that it's good. I'm happy to put my money where my mouth is. So we do. So I would say that the sophistication, the cynics will always be there. But if you speak to the learned ones, they will tell you that, yeah, okay, because they know at the end of the day, the manager as well as sponsor, the manager has to prove it beyond whiter than white that it is a good, and then the sponsor cannot vote.
I want to ask one last question on this like portfolio deployment, in the next few rounds, because you did point out that the Singapore, industrial REIT has a shorter lifetime,
Yes, land
right?
lease. Land
The
lease,
land
yes.
lease is about 30 years, and then there are freehold assets in other places that
Yes.
you play well.
Correct.
So, are you intending to deploy more capital in these foreign nations,
Yeah.
or are you going to try to manage that 75%?
No. So today, Singapore accounts for 75% of my portfolio.
Yeah.
And that's also because of this 75%, my land lease tenure is short. And I face land lease decay, what we call a land lease decay valuation problem. So my intention is obviously in the immediate term to deploy some of this to look at extending the land lease. And there are some assets, especially also in my sponsor group, there is Singapore assets still that has longer land leases, like 40, 45 years. Obviously, Japan is freehold, Australia is also freehold. So it's a balance. If you ask my frank opinion, if I start to deploy my assets, I'm 5.1, I start to deploy the money that I have that I raised and I sold the assets I would think that these assets would definitely, the deployment will still in Singapore and Australia. After I deploy everything and in the growth, Singapore will never drop below 50 in my view. Because Singapore has its attractions in terms of stability, in terms of very clear business rules. So that is and Singapore assets are financeable.
Important,
Okay,
very
okay,
important.
That is
And
most
you need to
important.
lever up,
Yeah.
Right?
Yeah.
So you need to even it out. Today at 75%, it's actually it's the land lease problem that's costing me. So, but it doesn't mean that I won't buy Singapore. I will only buy Singapore assets that are like 40, 45 years. And it's actually in my sponsor's portfolio. So that's why I tell you, I want to look at the sponsor's portfolio because the assets there are really good. And also I need to take a balance. The price of a freehold and a leasehold is different. So you need to balance that around as well. And our job is also part of the reason why we want to do rejuvenation. When you do rejuvenation of assets, when assets are newer, even though you lose, your land lease can lose 2% every year. But if it's rejuvenate and you can get a higher rental, the incremental valuation will more than offset.
Yeah, I get
the
it.
land
It's
lease.
a very commercial, industrial.
Yes.
property.
So that is the reason why, it's also part of the reason why you do, apart from staying relevant, is also on the capital value.
Yeah.
Fair.
So, but then in terms of the allocation of assets, so we covered geography. How about the type of assets? Right?
Logistics.
Still logistics.
Domain.
Some
I go back.
industrial have changed to a bit of data centers here and there.
Okay, I would say that I will always focus back on my domain. My domain knowledge of the group is logistics.
Okay.
Now, my sponsor is also going into data centers. They've been doing it for the 4-5 years already. I think at this moment, for our portfolio, I have certain views on data center, which probably not appropriate to share.
It's all appropriate to share.
Yeah. Different companies has different knowledge. But I would say that our domain knowledge, as far as I see right now, is on logistics.
Okay.
Let's focus our efforts on extracting and leveraging on that value proposition that we have. And that's why logistics will continue. As I said, if tomorrow the backbone is no more logistics, then that's a different story altogether.
Fair. I hear you. If that's the case, right, and Tuasport is a big thing, right, over the next 20 years or so, 15 to 20 years, and you have quite a few properties in that area, right, in the Tuas region. How are you looking at that? Is that your goal rush?
No, I think that's good. I know the cynics of that is, huge supply coming up. How are you going to manage it? No, I don't see that. I see that as creating a new community, a cluster. Singapore, if today there's a Tuas Megaport and PSA at Keppel remains, I think that is a new supply. No, we're all going that, moving that. And you look at Tuas Megaport plan, Singapore is a shipping hub. You need to have that. And once you create a community, you create that size, the pie becomes bigger. People like to see that the pie remains the same. The pie remains the same. So the new guy will eat the pie of the old one. Why do we say that? Why can't we see that it is part of a bigger pie? I'm not too sure this is an appropriate example, but if you look at 20 years ago, when Marina Bay Financial Center first was being mooted together, obviously with the casino, not casino, sorry, IR.
Integrated resort.
That's why I like talking to you guys. You can put it in a very analogical way. People thought that the Marina Bay Financial Center is just going to, make Tanjung Pagar, makes Raffles Place, make Marina,
suck it all up, right?
suck up all the demand.
Yeah.
Suddenly you have vacancy of 30-40% in whole Tanjung Pagar.
Mm.
Look around us right now.
Yeah. Fair,
Right?
fair.
It has Singapore, the whole Marina Bay as well as Raffles City has now become the real core CBD.
Yeah.
So the pie has become bigger.
Yeah.
And obviously, yes, there's rental difference. I mean, you locate in One Raffles Quay and you locate in a Raffles Place can be different, but it's not that big. So I'd like to see Tuas Megaport doing similar things to the whole Tuas area as well.
Which is very underdeveloped, I feel. In today's space in Tuas, there's a lot of space that can
there are
a lot of things.
But okay, one thing, why investors, no matter what happens, do you guys notice that when the world is in a mess, money flows into Singapore? There is a reason, right? You like it or not, yes, Singapore, people say that Singapore are boring, but sometimes when you do business, boring is good because you want clear rules, you want the infrastructure, the government of the day to plan it properly. That's what we want as a business, and there are proper plans on Tuas Megaport. We see it more as an opportunity rather than as a threat. Yes, along the way there'll be bumps. Sometimes suddenly they may put a big supply glut inside. It may suddenly affect. But our government is not silly. They are not here to destroy economic value. And I think for us as industry, as I said, I will, no matter how much I go outside and all this stuff, Singapore will always remain the core. And because Singapore remains the core, I must be able to see the economic fabric and the economic success of the country. And I do think that, yes, sometimes I do think that over the years in property cycle, especially for the industrial space, when the world is in exuberant form, yes, money does flow out of Singapore, going to Vietnam, going to China, going to everywhere. But if you look at the whole 10-year period, we're always this way.
Yeah. Okay, thank you.
Thank you very much, guys.
Yeah.